Hey, this is Sasha Evdokov, and welcome to another lesson. Now, today, normally I do a Let's Talk Stocks session, but in today's video, what I'd rather do is do a little educational video on the options chain and reading an options pricing table. I know I've had a handful of questions about options, and we did do an options chain video in the past. Unfortunately, the downside with that was the mouse was unreadable, and I thought I would just redo that video or recreate it. So let's take a look on screen, and I'm going to share with you how to read an options chain. I'm going to record the mouse, make sure it's on this time, and then also give you some insights about looking at an options table so that way you know how to read it. So let's go on screen. All right, so here we are on the Thinkorswim platform. Now I like using this platform simply because you can increase and reduce the font size, and it's a good teaching tool. Now, in order to get to the options trade grid or options chain or pricing table, depending on which broker you use, they may be called a little bit differently. In the Thinkorswim platform right here, what you do is you go into the trade section and then the all products. It's not under the active trader or the futures trader or the Forex. It's under the all products. So if I go ahead and type in my ticker symbol here at the top, I can go ahead and type in, let's say, Microsoft, and then there's the options chain. There's a trade grid right under there, but we're looking for the options chain. That's how you read the options. And normally that's how you will see them, is they'll laid out by date. If I go ahead and type in Amazon, AMZN, then you see those right there. If I type in Google, you'll see them right under there. So for example purposes, let's go ahead and use Tesla. Okay, so you can see I have the options chain open by clicking that arrow, okay, that arrow right there, and that'll open up that options chain, okay. Now, certain brokers allow you to sort options by category. Now here I have a standard single. What I could do is I could sort it by vertical, I could sort it by a straddle and strangle, and a butterfly. And you don't see any of the differences right now, but you will see them here shortly in just a minute. So before we get there, you'll notice that the options are sorted by, you have the main date right there, which is the month, and then you have the days until expiration right next to it. So you can see that, let's just take one for example here. This one is the August 18th expiration with 78 days to go. Whereas here we have the December expiration with 197 days to go, okay? And then over on the side, you might have something where they're the non-standard options or they're the weeklies. In this case, here are some that are the weeklies, okay? On the right side here is basically the volatility, and that's plus or minus a certain amount as well. But this is basically the volatility of those option spreads. And you'll see that some of them, like these in the 40s, are a little bit higher volatility than the ones closer, okay, closer to the date currently. So with that being said, as you start opening up these time frames, let's say you're looking at the 50-day options, you would open up this July right here, and you'll see the 50-day options. Now, when you start this process off, it's a little bit confusing. So let me reduce some of these strike prices. Let's just do 20 right here. And actually, let's go to even 15 or 10, okay? So when you look at this right here, you'll notice that we have 50 days to go, okay? 50 days until last trading day of these July options. Now, we're currently in June, okay? So we're in June 2017 on a Thursday. And here, these are 50 days to go. And what you can do is you can see that you have two main concepts here. You have the calls and the puts. Okay, so the left side typically is the calls and the right side is the puts. How do I know that? Well, it says right there, calls, and then this one says calls and then the puts. So you'll see that right there at the top. Sometimes it's a little bit more difficult to find that, but if you're familiar with your trading panel, it'll tell you right there, calls or puts. Okay, so calls are typically, if you buy a single call, they're typically used for an upside direction. Okay, it's like buying a contract predicting or projecting that a house price is going to go up. Okay, the same thing on the put side, except you're projecting it for the downside. If you purchase a put you're looking to go ahead and short sale a house, in other words. But keep in mind there's 4 parts or 4 sides to any of these option trades. You could be a buyer of a call, or you could be a seller of a call, and you can be a buyer of a put and a seller of a put. So if we're talking about just the general basics, if you're buying a call, you're looking for it to go up. If you're buying a put, you're looking for the stock or equity to go down. Okay. Now, with that being said, you'll notice that in here, here's our date again. You also have the strike prices. Okay. So Tesla right now is trading at 340.49. And these are the strike prices. So if I'm looking to buy a call at the 360, okay, this basically says that I have my 50 days to go, that it needs to hit about 360 for it to be worth anything. Now, can it move a lot quicker and you get out of it sooner? Yes, you can do that. So if it goes up to 360 in one day, you can get out of it, and this price that you pay is going to be worth more. Okay, so it's going to be worth more. So right now you would pay $10.45 for that contract, multiply it times 100, because each contract controls 100 shares. So you would pay, as we go right here, right click and buy a single, analyze the trade. Okay, you'll notice what you're actually paying is you're not paying $10.45, okay, $10.45. You're actually paying $1,045. And this is what a profit picture looks like, okay, on a call contract. So what this does is show you profit and loss on a call contract or on your position. So on the bottom is your prices. Okay, so if you're looking on the bottom, this is your strike prices. Okay, and then on the left and right, what you have actually is your profit and loss. Now the white line right here is your current date, okay, the current date that your position's at, and the green line is at expiration. So as time moves forward, and I'll have to reduce the font size here a little bit so that you can see this. Okay, so we'll just go to a standard font size here. So as time moves forward and as I shift and adjust the time, okay, because as you know, time decays when it comes to options if you're just buying a single one. And you can see what happens to my theoretical profit and loss. Okay, so there's my current profit and loss. Let's reduce these additional slices, which are the plus or minus 10%. But as I move and shift the time forward, you can see that white line gets closer and closer to the green line towards expiration. Okay, so that's what happens with a basic call option. But you can see the theoretical concept is if you buy a call, you're looking for it to go up. If I go ahead and do the same thing on the put side, and let's say I project that this stock is going to go down, I could say, okay, well, let's go ahead and buy the 320. Okay, we'll do the single, analyze the trade, and you can see what happens, that as the stock goes down, okay, so the stock goes down, here's all our strike prices, and as we continue moving to the downside area over here, you can see my profit actually heads higher, right? So my profit increases as that stock goes to the downside. And if it increases to, or if my profit and loss increases in one single day, that's perfectly okay. So even if it goes in 2 days, 2-3 days, I might lose a little bit on the time value of that option. But if it jumps to, let's say $10 to the downside, I'm still profitable $270. Can I get out early? Absolutely. You can get out early. You can get out as early as you want. You could get out in 2 seconds if you wanted to. But that's the way the put side works. So looking at this, what else is in here on this trade grid, okay, or this pricing table? Well, you have the bid and the ask. So this is the bid and ask on the puts and the call side. So if you're looking to buy a call, right, you're going to be paying the asking price, or maybe somewhere in between the bid and the ask if you can get a negotiated rate, right? If you're a seller, okay, you're going to be getting that asking price. Okay, so depending on where you want to sell it at, you know, on your strike prices, if you're going with a, let's say 360, okay, you're trying to sell it at 1050, but you might only get, let's say, 1030 because people are trying to buy it at 10. So somewhere in the middle is what you might end up paying. So if you take a look and let's just say we buy a single, you can see right there, the natural price is 1050. The mid price is kind of 1040, 1045. So you might be able to get somewhere in between this level, and the prices are constantly shifting. So, 5 cents here or there, you might be able to get somewhere in that range. So that's called the bid-ask spread, is that range, okay, that you're paying. And you can see some of these have a wide bid-ask spread, and others, if you look at, let's say, the SPY, have a very tight. You see these are 1 cent bid-ask spread. So it's very minimal. Whereas if you go with the SPX and you look at it, the bid-ask spread is a whole dollar, right? So you can see the difference here on looking at different option prices here, that the spread is different. So let's go back to our Tesla example. So here, as you look at this, you take and decide which one do you want to buy. And there's a lot of different ways that you can decide depending on what you want to do. But the other thing that you want to watch for is the open interest. So here we have the open interest. That just tells you how many open contracts are out there on those on that set. So this would be the call side. If you look at the open interest on the put side, that's your open interest on this side. Probability of in the money is the percentage that I have up right there. That's the probability of in the money of it working out in your favor or these becoming valuable. So that's right there. Now, you can change these, of course. I could go ahead and say, okay, let's change these columns to, I could say the delta, right? So the delta, the move that I make on a per dollar move on the stock. I could say, let's look at the volume for today. I could change it to, let's look at the theta. How much theta am I going to lose on each one? So there's a lot of things that you could do. Let's see, there's another one. Let's say the implied volatility, right? So you could look at implied volatility. So you can do a lot of different column changes and adjustments within these things. But for me, typically what I do is I look at the probability of in the money. And then the other thing is the open interest, just because I want to see how liquid things are. So with that being said, you can also adjust these strike prices, right? So if you want to see 14, you could change it to 14. If you want to see 100, you could see 100. And you'll notice that in here on the right there at the money, this is what typically people call at the money, is right when there's something that's worth a dollar amount at expiration. So notice that this color is a little bit more purple. So all of these call contracts are worth something already. They have that intrinsic value, and they are actually in the money, okay? Now, the same thing on the put side. Anything below that range, that line, okay, let's make it nice and thick, okay? So anything below that level, you can see these are worth something. And in the call side, anything in that range, okay, in the orange range, those are worth something. Everything else is basically out of the money. So here in yellow, I'll say on the put side, those are out of the money, and these over here are out of the money. And typically those are the ones you'll trade, okay? Those are a little bit more of what people will trade, put positions on. Now, what you can also do is go in and change this from just looking at a single spread. You could do, let's say, a vertical. And now what they'll do is you'll notice start making changes to these strike prices. So you can see you can do a vertical on the 320, 325. You could do it on the 330, 335. If I go further out, I could do a 78-day, same thing. I could change this to a calendar. And now you'll notice there's a big difference because now they put together calendars, let's say on the 50 and 78 days. So I could go ahead and open this up and you'll see that there's a calendar right there. So at the 280, I could do, let's do 10, and you'll see I could do a calendar on the 360, the 350, the 330, 335. So you can see that you can really adjust these positions or the pricing table really based on the way you trade. For me, typically I do a single, and even if I'm putting on a calendar, I'll go ahead and say, okay, well, I'll go to the 350 strike price and I'll buy a calendar, and I'll select that, and then I can go ahead and analyze the trade. Let's get rid of that single position. And now I can make an adjustment to my prices if I want to move that calendar around. But with that being said, that's pretty much the basic pricing table or the options chain and how it works. So you go into the all products, you type in what you want. Let's say I want Amazon. You have the calls over here on the left. You have the puts on the right. You can define the amount of strike prices you want to see. And the strike prices are right there. So those are the strike prices you're trading, and you get a chance to choose how many days out you go. So one is 15 days, you have 50 days. If you're choosing weeklies, these are the non-standard options. If you want to go further out, you could do 78 days, you could do 106 days, 141 days. So they continue to increase. So if you're looking to trade really far out on your options, you can go ahead and choose that. And let's say we go 141 days. If you're doing single contracts, like buying a call, you're looking for the stock to go up. If you're buying a put, you're looking for the stock to go down. So you get to choose the strike price. Does it matter which one you choose in terms of if you're getting out within a day or two? There are advantages, because the closer you get in the money, right, where the current price is, the faster it moves, okay? The faster, the more money you make on a per dollar basis. But, if you go out a little bit wider, you pay a little less, but you still capitalize on that option. So let me just show you an example. If I buy a single at the 1040, okay, on the Amazon, and let's make it a live price, go to today. Okay, so you can see for every dollar move that this stock moves to the upside, I make $47. That's what the delta tells you. If I go to, let's say, the 1070, I only make $40. Okay, can I trade one or the other? Yeah, absolutely. It doesn't really matter in the sense of if you had no preference and no risk preference, then it doesn't matter. But the one on the 1070, you spend $3,150 and you make $40 for every $1 move in the stock. Okay, for the one at the 1040 level, okay, you're going to spend a little more, $4,180, but you make an extra $7 for every $1 move in that stock. Okay, so in either case, that's how it works in these option positions, is that, the more money you spend, the more you make on a per dollar basis. If you're doing a put, same kind of concept. So let's say if we look at this put and you're looking at the 970, okay, you could go right here at the 970 put. I could put this on. Now you're starting down $800 because of the bid-ask spread, and Amazon is so huge. But in general, as that stock goes down, right, you're making $33, and it's a negative because you want it to go down. You make $33 for every dollar move. So that stock gets to 950, you're profitable about $1,900. Now that doesn't happen in a day. So let's say it takes you a week, you lose some money on the theta. That's what the theta tells you, how much money you lose on a day-to-day basis. But you're still up about $1,500 if that's within a week or two. So that's kind of how those these basic options work on a pricing table. That's what you're looking at. If you're looking to go further out and you don't have that kind of capital, but you still want to trade, let's say Amazon, you could open this up to 200 strike prices, right? So you could say, okay, I'll do the 800. Even though the stock is trading at 994, you could say I'll do the 800 because you'll spend less. So I'll go to the 800, and you can see it's really far out, okay? But look how much you're risking. Instead of the $3,000, $4,000, you're risking $670, right? But your delta, you're only making $8 for every dollar move down that stock goes. And you could do the same thing on the call side. So let's say I change this to the call side, and instead of doing it close, let's say I go to the 1250 or 1300 calls, right? It's not as realistic for it to go up in 1 month, but you could hold it for however long you want to. But instead of spending $3,000, you're spending $255, right? And you're getting $4 for every dollar move in that stock. So as that stock heads higher, you're getting $4. Now keep in mind, you're losing $4 on a day-to-day basis. So you need that stock to keep heading higher $1 every day just to break even because of that time decay. So keep that in mind. But if this stock explodes and let's say pops 20, 30 points in a day, you could make pretty good money. But that's the problem, is with a single option, there's that time decay problem, which is a whole nother video on its own. But that's how you look at some option pricing tables and some strike prices, and how you really start to look at options and how they work between the bid-ask spread, the open interest, how you start looking at contracts. That's just the baseline for things. Hope you enjoyed this video and you saw a little more clearly what it's all about. Again, this is just scratching the surface. If you really want to get into options, you may want to take a look at one of my courses on my website at risetoloearn.com, or really get into some of the other free training videos that I have on TRADERSFLY.com. Now, if you want to join me on a live class or just get some new updates and information, and as I release new courses and products and material, even free video lessons, join me on my newsletter list by clicking the button over here, and you'll be sent those newsletters as they are released. Thanks again for joining me in this week's lesson. Hope you enjoyed it, and I hope to see you next time.